Coming up today, stocks continue their pullback on the back of hot inflation data. Will the Fed still cut rates next week? Are we getting a recession signal? And all the other most important news, data, and charts from today. Let's go, guys. And welcome back, everybody, as we're continuing to pull back in the market here on another negative breadth of a day. Now, 9 consecutive days of more declining stocks than advancing stocks. We haven't seen that since 2001. And so that was exacerbated today by PPI inflation coming in quite a bit hotter than expected, doubling what economists were forecasting. We also got a little hot print on jobless claims as well, all of which I'll get into later. But first, let's just dive right into the technicals and take a bird's eye view at this market. So we're just looking at the 1 week heat map performance here, and we can see that real contrast between mega cap tech coming back, led by Tesla and Alphabet. Also got Apple and Microsoft trading strong, and then most other sectors pretty much red, especially healthcare, utilities, and energy, with some of the biggest blue chips in these sectors as well. Coming off hard this last week, including NVDA. Overall, a bit mixed in the semis there, but we can see that kind of negative breadth currently washing across the market. And so yesterday marked 8 consecutive days when the S&P 500 had more decliners than advances. We hadn't seen that since 2018, but after today, that made it 9 days. We hadn't seen that since 2001. And so looking back in history, when we get this persistent negative breadth in the short term, that can precede a bit more weakness. Looking out over the next couple of weeks, even month or two, market only higher a month later 39% of the time, for a median return of negative 2.6%. So like I've been saying, we may have gotten a little too hot. We'll certainly hit in the top deciles and a lot of sediment indicators, and how technically stretched we are, signs of froth out there. So it's no real surprise to have a bit of a pullback underneath the hood. But once again, it's mega cap tech holding up and continuing to drive the main indices of the S&P 500 and NASDAQ as well, even though we've had a pretty good year this year. S&P up over 20%. Less than a third of all stocks have outperformed the S&P 500 this year. And that traditionally would make it a tough environment to be a stock picker, as most stocks are underperforming the index. However, it's kind of a similar pattern what we saw back in the late 90s, when big tech stocks were screaming ahead back then as well. And so could we see a bit of a reversion to the mean, making it a stock picker's market, like what you typically see when the market's a bit soft or in a bear market or going sideways? A lot of those years, more stocks than not outperformed, because like the late 90s, we do have signs of froth out there. And unlike back then, different this time is we've got cryptos. And even today, Fartcoin's market cap is now greater than 38% of all American publicly traded companies. It's kind of astonishing, isn't it? And so I wonder how much further this can go. Is Fartcoin going to overtake half of all American traded companies in valuation? Could this possibly be a currency of the future? Maybe not, but what we do have different from the late 90s is, even though we've got bad market breadth for the here and now kicking off December, the overall market structure is a lot more healthy compared to the late 90s. You're looking on the right-hand side of this chart here, the March 2000 high, on the left side where we currently are now, just looking at a bunch of indices, the S&P, transports, utilities, small caps, financials, cyclicals, and equal weighted, and probably most importantly, the advanced decline line. And so the contrast between now and back then is we had plenty of divergences in the market. Transports were coming off along with financials, another divergence in cyclicals and equal weighted indices as well, along with persistently bad market breadth for well over a year. Whereas for the here and now, all of these indices are pretty much still on an uptrend. So for now, we could still interpret this as a short-term market pullback in an overall healthy bull market. And even though valuations are definitely not cheap, believe it or not, they're still not back to the crazy levels of the late 90s. When looking at tech stocks forward PE, they actually reached above 55 back then, currently about 28. And just looking at the S&P excluding tech and their forward PE, that actually got up to about 27 in 1998. We're currently at 20. And the forward PE of small caps is around 15. So they're not too bad at all either. And we got some good charts from Fidelity today. So looking at the S&P total return with a trend line in since 1871. Down the bottom here, you've got the deviation from the trend. So you can see in 1929, we got 92% above trend, mid-60s, 87%. The late 90s, we got 114%, currently at 50%. So we are definitely above trend, but not near those historical extremes either. And this is my favorite chart of the day, also from Fidelity. In the dark gray line, we've got the current S&P 500 real return, and down the bottom, we've got the 10-year compounded annual growth rate. We can see that on the right here, with 0%, 10, 16%. Overlaid on the chart in the purple line is the secular bull market from 1949 to 1968. In the orange, the secular bull market from 1982 to 2000, with them all being indexed to where this current secular bull market bottomed in March 2009. So what you'll notice in this chart is the current secular bull market's following a very similar path to that of the last two, especially in compounded annual growth rate. So you could kind of think of that as like the velocity of the secular bull market. That appears to have topped out in 2019, around the same period of time the last two secular bulls topped out as well. So the average annual return each year may have already peaked out, then it kind of goes sideways for a few years before turning over. And just looking at the real return as well, if this secular bull were to follow a similar path of the prior two ones, we could actually be approaching a top and then in for a bit of consolidation sideways before potentially rolling over a bit. And so I see this as a likely future path the S&P could take as well. It may not be the binary outcome a lot of people are expecting, that we melt through the roof above S&P 10,000, nor may we get a big doomsday crash. Like I said, we may just put in an 8-9% return next year, maybe drift up into 26, 27 before rolling over, having a 30 to 40% correction, and we just kind of bump around. And before we know it, we've got a lost decade, just like we had after 2000. Market didn't reach new highs till 2013. And then by the time this has happened, time has caught up to the trend. We may have a dip below the trend, and that'll be the next secular bottom. But I think it would be fair to say we're probably closer to the end of the secular bull market than the start. But again, I just want to underscore the fact we're talking about the S&P 500 here, not global stocks, not every asset class. Because many international markets out there, which you can easily invest in via the New York Stock Exchange, look completely different to this. And so for the here and now, we still have positive signals in the economy and market. For example, of late, we've seen a surge in economic and consumer sentiment, climbing 22% over 3 months to reach its highest level since April 2022. And so that often spurs increased consumer spending and business investment, and they're pretty much the two biggest drivers of economic growth. And so you can see, looking back at the last two bull market ends, the economic and consumer sentiment composite was tapering off 05, 06, 07, along with the late 90s as well. We didn't have any of these big positive 3-month changes above 20%. So for the here and now, generally speaking, consumers are feeling a little bit better than they did a few months ago. And we've got Wall Street analysts like Dan Ives saying he expects tech stocks to be up another 25% next year under their base case, based on underlying strength from the AI revolution and the second, third derivatives of this tidal wave of tech spending, and AI capex abound. He thinks it's 10 p.m. at the AI party that goes until 4 a.m. Also heard from Bill Ackman today, speaking at the New York Stock Exchange, who said we're stepping into the most pro-growth, pro-business, pro-American administration I've perhaps seen in my adult lifetime. And this was on the back of the incoming president ringing the opening bell at the NYSE this morning, and was also just named Times Person of the Year. And it was also interesting to hear that Trump invited Xi Jinping to his January inauguration, maybe extending an olive branch, or maybe a negotiation tactic. This Chinese analyst thinks Xi will probably accept, but will appoint a representative instead to attend. Chinese stocks did catch a little bit of a bid on that news. They actually just finished a bit above flat today, contrasting American stocks. But by no means are we out of the woods yet on the China trade. Still think we're in for a bout of volatility, and could be quite a few months before this thing settles down. And it might actually be the Europeans that could have more to worry about instead of China. Just heard from NATO chief today saying they're not ready for what is coming in 4 to 5 years. It's time to shift to a wartime mindset. And he says this is due to growing threats posed by Russia. He said NATO members need to significantly increase their defense spending to at least 3% of GDP, saying they're not ready at this point in time. And so I think he's learned from Trump's first term that Trump won't keep blindly financing NATO in a disproportionate fashion, as America had been footing most of the bill for a long time. And so just like energy and how they relied on Russia, gave away their nuclear, almost completely relied on wind. And even today I see electricity prices in Europe skyrocketing crazy levels, as they don't have much wind at the moment. Also with their security, they're probably feeling a bit vulnerable and scrambling to make up for their shortfalls, now that America may not always have their back and just blindly finance them with a blank check. And just looking at European stocks on the whole, at the Euro Stoxx 50 index, basically been consolidating all year and actually got sold off pretty hard going into the American election. Although we have had a little bounce here, but still well and truly underperforming American stocks. It's actually emerging market stocks holding up a bit better than European stocks. Just moving on to inflation today, US producer prices, PPI index coming in 0.4% month-over-month gain, double economists' expectations. Driven by a jump in goods prices, which rose 0.7%, while services only came in 0.2%. And just looking at a 1-year chart of PPI, that was actually the hottest print we've had for the entire year, and it's kind of been uptrending these last 6-8 months. But it's going out to a 5-year chart, still well off those big peaks we had in 2022, and it's going out to a 10-year chart, kind of a similar readings we had back in 2018. But like we've been saying, inflation may have found a little bit of a floor, could be close to breaking out again. Definitely upside risks there. So the Fed meets next Wednesday, the 18th, to decide on interest rates. Are they still going to cut or not? After we got a little hot print today in PPI, while their favorite gauge of inflation, PCE, is not due out until after they meet next week. But that didn't rattle the pricing for Fed fund futures today. In fact, they actually firmed that the Fed will cut next week. The forecast is PCE should still come in tame, and the Fed's determined to get one more done before the end of the year. Traders pricing in about 95% odds they will cut next week. And we can't also rule out the possibility that the bond yield curve may indeed still hold up and play out, even though it's already really late and we could get a recession. Because like Societe Generale points out, we do have some signals there in addition to the bond yield curve. The curling unemployment rate upwards above averages is definitely one. And we just saw that again today with initial jobless claims coming in a bit hot. Economists were forecasting 220,000, we actually came in 242,000. However, we can see a bit of volatility after the Thanksgiving holiday, and data's been skewed of late by strikes and hurricanes, so the market doesn't seem too worried about it for the here and now. The 2-year still trading around 420. Actually saw a bit more of a tick up in longer durations, the 10-year and the 30-year jumping back quite a bit. I'd say indicating that prices should remain firm in the economy, along with economic strength as well. It's causing a bit of a fall in TLT there today. But overall, high yield bonds still holding up pretty good, along with high yield credit spreads still very low as well. What hasn't been doing well of late and got punished again today, healthcare stocks. Ever since the United Healthcare CEO shooting, it's kind of shaken things up quite a bit in the industry and the stock market as well, shining the light on the state of the US healthcare industry and how significantly different it is from every other developed country out there in terms of costs and health outcomes. And we're now seeing in New York City wanted signs popping up targeting Wall Street and healthcare executives. Police said they're investigating signs encouraging violence against executives. Once again, another sign of the times. We're also just hearing a lawsuit, the first of its kind. A teenager is suing 11 major food companies for engineering ultra-processed foods that are addictive and as a result have caused them chronic illness in the form of type 2 diabetes and non-alcoholic fatty liver disease by age 16. The 11 defendants listed in the lawsuit are Coca-Cola, Conagra Brands, General Mills, Kellanova, Kraft Heinz, Mars, Mondelez, Nestle, Post Holdings, and WK Kellogg. And some of these stocks have just been absolutely whacked of late, like Nestle, one of the world's largest snack makers. Looks like a persistent sell program in the market here. And others haven't been doing too well either. Pepsi, Coca-Cola, it's been trading pretty heavy, and Hershey as well, which was looking like Mondelez may take it out. However, the market's not so sure at the moment, bumping around here. Not to mention United Health getting slammed again today, down 3.33% on heavy volume. Looks like big money is bailing out of this, and maybe they're happy with their 10,000% gain over the last 25 years in the stock. The trade may have been gotten. US healthcare costs may have hidden a blow off top on the back of this event, because it's just such a stark contrast in the transfer of wealth from the cost of healthcare for everyday Americans to the huge explosion in the stock prices and the executives on the other side of that spend. Maybe this is not normal that America's largest healthcare stock goes up 10,000% in 25 years. And maybe this is due a big correction like the cost of US healthcare is as well. So I, for one, certainly wouldn't be touching stocks like this. And the whole healthcare industry getting sold off hard at the moment, actually. And just looking at my sector breadth table, it's one of the weakest sectors looking at multiple timeframes here. Still got tech and financials holding up the best. And it's not just consumers that are frustrated with the current state of affairs in healthcare. Doctors as well. They're saying dealing with health insurers is only getting worse. Medical providers are frustrated by the aggravation and expense of convincing insurance companies to pay for their patients' care. And so this unfortunate event may have just set off a chain of events. In tandem with the new government, RFK, and this theme could play out and ripple through markets for the next several years or even longer. But just to finish on a more positive note, got news today, American universities Kogod School of Business has confirmed with their own study that Tesla makes the #1 most American-made car and they dominate the top spots. The Model 3 performance, 87.5% of what's in it is domestically made. With Tesla also having the 2nd, 3rd, 4th, 5th, and 6th spot as well. Ford Mustang coming in next, 80%. Then you got Honda, Jeep, Volkswagen, Chevrolet. And so that's a pretty good position for Tesla, especially if tariffs could affect some of these other automakers importing parts from around the world, whereas Tesla already gets above 80% domestically. And that's kind of what's been funny about the current admin. They said they really wanted to get behind American-made automobiles. Well, Tesla is the most American-made car out there, but they never acknowledged them. They didn't even invite Tesla or Elon to Electric Vehicle Summit at the White House. And that, among a few other things, may have been part of their undoing, as Elon definitely held sway over this election's outcome. But I'd say, again, in my opinion, and I'm sure some people will disagree with me, probably the current admin's biggest undoing and why they lost this election was putting Biden in there in the first place. The guy was too old for the job from day one. And then also their pick for VP based on wokeness blew up in their face as well. On top of record government spending, causing significant inflation, total failure at the border, geopolitics, the worst we've seen in our lifetimes. I think all these things added up to America turning back to American first politics. And that's where we stand at the moment. But anyway, just getting back into the charts, VIX index still pretty low, even though we're pulling back underneath the hood. It's really mega cap tech holding up the indices and probably suppressing volatility as well. Although we do have volatility risk premium a little elevated at 5.7. Option dealers not willing to write contracts as low as the market's actually moving. And just looking at some commodities, crude still bumping around $70 a barrel and a bit of a pullback there in gold today. While agricultural commodities still holding on to their yearly highs here. Kind of a similar chart to producer prices. Cost inputs into the economy. Bar oil have been climbing of late, but it seems like mega cap tech is still trading firm and a bit of a rotation this last week or two. Typically, the second half of December is more bullish than the first half, especially in small caps. So we'll see whether the Russell can defend its 50-day, just like it did about a month ago, and whether the Santa Claus rally is still on its way. Thanks very much for sticking with Click Capital, and I'll see you guys again tomorrow night. Cheers.